Joining me now to analyze the Fed statement and Janet Yellen's comments are Christopher Vecchio, currency analyst at dailyfx.com, and John Herrmann, the director of U.S. rate strategies at MUFG Securities. Gentlemen, thanks for joining us.
Thank you for having us.
So the Fed saying that the case for an increase has strengthened, but decided for the time being to wait for further evidence. You're smiling, John. What's your initial reaction other than that giggle?
Basically, I was very pleased with the statement. She reintroduced what I call Greenspan type guidance. So she strengthened the forward guidance. She made it more time dependent. Our own forecast for payrolls, industrial production, retail sales, and so on over the next couple of months is improving. So to us, this language suggests they're going to raise rates in December. You know, possibly a small chance of a November hike, but really most likely December.
What do you think?
Well, at this point in time, the way the Fed's behaved the last several months, and really all these central banks, in an effort to become more transparent, to become predictable, they're not hiking or cutting rates unless they have new staff projections in hand. So seeing as how the next round of staff projections come in December, and Janet Yellen has a chance to go in front of the podium, that is when we're looking for the next rate hike.
But you say they've become more predictable. You say you're happy with the language, that it's more clear. But really, what is the difference? Because Jackson Hole, very hawkish talk over there. And from Stan Fisher as well, he said that we could even see 2 hikes in 2016. Right. And let's not forget that December of last year, the Fed was gearing us up for 4 rate hikes.
Exactly. So, so that part was a little bit of a mistake back in December. They were too optimistic on GDP growth. Now they've sort of toned it down. They've shaped the profile for GDP going forward, not as strong as previously expected. But as you mentioned, they had the troika of Dudley, Fisher, and Yellen at the end of August, really gearing us up for a hike. But we didn't have the incoming data cooperating. So she said today, she said, when we get the incoming data cooperating, we're ready to go. And as I'm telling you, my models are saying, look for good November and October, November data, and they're going in December.
Well, Chris, do you think that they should have raised by now? Because many are people saying that the Fed has lost credibility by making all of these hawkish statements and not pulling the trigger yet.
Right. Well, if they were to have raised, it would have been years ago. Today wasn't necessarily the right point in time. We're seeing that even though labor data has been good, inflation isn't there. Wage growth is still somewhat subdued, and the market wasn't pricing it in. The Fed doesn't want to shock the market. It doesn't want to lose that credibility. So Fed funds today were only 20%. Small chance that the Fed was actually going to do so.
Well, some are saying that it's a case of crying wolf, that the Fed has been saying this, so the market's just dismissing this kind of language. What makes you think that it's different this time?
You know, I think the thing is, one, again, they're putting their own credibility on the line now because it's in the statement, and it's this really very well crafted Greenspan type, time-dependent forward guidance. That's very, and they're linking it very closely to the timing of the normal upswing in fourth quarter data on payrolls and retail and production and the like. So it looks like all signals go.
You know, Chris, John mentions Greenspan, and the words irrational exuberance can't help but come to mind. And many are saying that with this era of easy money, we are creating certainly bubbles in certain sectors, very much so in the corporate bond market. What do you think?
Sure. I know Robert Shiller probably wouldn't be that thrilled with everything that's going on right now, and he's said the exact same thing. I think when you look at some of the speech you've had from these Fed policymakers, they're even talking about creating new bubbles. Yellen a few years ago spoke about the biotech overvaluation. So the Fed right now is in this tough place where it wants to start to pull away to give itself some breathing room, but the economy still evidently has some slack. Even though the employment rate is so low, wages just aren't there.
But you both see a December rate hike.
Absolutely.
They need to save face.
And what impact would that have then?
I think the market's pricing it in at this point.
But what impact would that have on the economy at large?
I think in general it's going to have a relatively small impact. I think the election potentially could have a larger impact depending on whose fiscal policy gets enacted and so on. But for the Fed, as you're arguing here, I mean, there was a basis. There were bases for questioning the extent of all the QE and supporting the equity prices and so on. You know, but we're very far down the road. And as Chair Yellen said today, the most unusual thing about this year in terms of the job market type performance is that we've actually brought into the labor force people who had been previously pushed out. And that's the first year in 8 years that that's happened. So from that standpoint, I kind of understand the situation Yellen's in. I tend to agree.
Well, Chris, assuming the Fed does actually pull the trigger in December, we heard from the Bank of Japan today, it's keeping its very easy money policy. Can the Fed go in the opposite direction to practically every other central bank out there?
Right, and that has to be a consideration the Fed's looking at right now. With respect to the BOJ and even the ECB, it seems that their focus in the near term is examining the efficacy and effectiveness of their current programs rather than looking to implement new measures. What the BOJ did yesterday was outstanding in the sense that they did something that the IMF and World Bank and all these other institutions tell emerging market economies not to do, and that's they locked in their yield curve at 0%. So when you look at the BOJ and the ECB, they are taking extraordinary measures. That's going to keep pressure on the dollar to the top side. Right now, with the way the rate glide path is looking, probably see the dollar stay moving sideways and stay elevated. So for manufacturers in the U.S., that could be a problem, especially if the ECB.
But what is interesting is the initial market reaction to the BOJ announcement was to weaken the yen. But by the time today closed, New York time, the yen was much stronger, and here we are back to that $100 yen threshold, which is a strong yen that they do not want over there. So at the end of the day, if the Fed moves very gradually, so that once last year, once this year, maybe once to maybe 2 times in the next 24 months, let's say 18 to 24 months, it's such a gradual glide path that, maybe it doesn't have quite the, horrendous effect on the dollar.
Well, besides dollar yen, you got to think about the yuan in China. I mean, yuan yen is down 25% over year.
Lots of factors to consider, but certainly a rate increase will probably boost the dollar there. We're going to have to leave it there. Thank you so much. John Herrmann, Director of U.S. Rate Strategies at Mitsubishi UFJ Securities, and Christopher Vecchio, Currency Analyst at DailyFX.com.